Hey everybody, this is Rob. Just getting back at you today. So what we got today is banking is a scam. Let's jump into it. All right. Let me go ahead and switch my slides. All right, banking is a scam. All right, and let's get into why it is. Right, because we do something called fractional reserve lending in the banking world. Right. So ChatGPT says fractional reserve lending is a banking practice where banks keep only a fraction of their customers' deposits on reserve, i.e., in their vaults or with the central bank, and lend out the rest to borrowers. For example, if a bank has $100 in deposits, they might be required by law to keep 10% or $10 in reserve and then lend out the remaining 90%, $90 to borrowers. This creates new money in the economy as the borrowers now have an additional $90 that they can spend or invest. However, this system also means that if too many customers try to withdraw their deposits at the same time, the bank may not have enough reserves to meet all the demands, leading to a bank run or a financial crisis. To prevent this from happening, central banks, excuse me, central banks usually set up a minimum reserve requirements for banks and act as a lender of last resort to provide liquidity in times of crisis. Sound familiar? That's what happened this past week. Mm-hmm. So I found this illustration somewhere online. And basically what it's showing is a customer deposit at $100 goes into a bank. The bank then lends that out 90% of it, which is $90, right? Oh, I forgot, I left out this part. They keep $10 and lend out the 90. The 90 is here. Goes to a customer. Customer does whatever they do. They deposit into the bank. The bank holds 10%. This is bank A, bank B, whatever, bank C. Three different banks were in this example. I wish it could go on and on because it would show you how much money it becomes. I believe it becomes like $1,000 at when it's all said and done. So so bank B keeps $9 and they lend out 81, 90% of the value, right? And the process repeats on and on until you end up from 100 to $1,000, right? And let's summarize. So number one, I forgot to tell you how this video is going to flow. So we're just kind of going right through some banking, some banking, what do we call these? Just banking policies, I guess we can call it that. We're going through these real quick. I have a couple of videos to show. One is about a minute long and one is about 6-7 minutes long. So I want to go through this kind of fast because they explain it a little bit better. And they kind of add some depth to it, right? So what I'm trying to say. So the creation of money is basically what this is, right? You start off with 100, you go to 1,000 out of nothing, and only 10% of the reserve. So out of the entire the $100 they started with, I think they roughly end up with about $100 in the bank in all these banks when it's all said and done. $100 in the banks and 900 out of thin air that does not exist. $100 is in the reserves. Okay. So yeah. So when you look at the bullet points, through this process, $100 becomes 1,000, creating $900 in money that does not exist. If these numbers are not accurate, so what? I'm just trying to get the ballpark, right? This is just showing ballpark numbers, zeros for easy calculations or whatnot if you want to try it, right? Creating $900 in money that does not exist. This is the inflationary nature of money. This is the problem with money in the system that we use, right? Money tends to inflate no matter what. So when they say they're trying to fix inflation, I'm not sure what they're trying to fix because it's impossible to fix inflation. What this process we just talked about, ChatGPT, as well as this process right here called fractional reserve lending, is by nature inflationary. It inflates the money supply. Okay. So they can never fix inflation, like they say. They can raise the interest rates to 100%. You can't fix inflation. All right, here we go. Next. All right, so yeah, I got this little quick video I wanted to jump to. Let me see if I can jump to it this way. I lost my tabs. Oh, there we go. And I don't have my tabs. All right, let me go back. All right, let me do this again. 1 sec, maybe it'll let me click it now. Okay, well, God dang it. 1 second, let me cut and paste this. Copy, and right here. All right, yeah, I got a short video. Let's tune in. I'm gonna go on mute for a second. 1 minute.
Banks are allowed to create money through a system called fractional reserve banking. Whenever you deposit money, the bank is legally required to keep a certain percentage of it somewhere safe, but can lend everything else. Here's an example based on a 10% reserve requirement. John goes to his bank and deposits $1,000. John's bank keeps $100 and lends the remaining $900 to Mike. There is now $1,900 in the financial system. John's $1,000 deposit and Mike's $900 loan. Next, Mike uses the $900 to buy a laptop from Karen. Then Karen deposits her $900 at another bank. The bank keeps 10% and lends the remaining $810 to George. There is now $2,710 in the system. John's $1,000 deposit, Karen's $900 deposit, and George's $810 loan. This goes on and on until John's initial $1,000 is turned into approximately $10,000. Believe it or not, commercial banks actually create more money than central banks.
How banks make money. It's not how you think. Let's take a look how most people think the banking system works. The saver deposits his money in the bank. The bank lends.
God dang it, I just realized I was talking on mute. Let me go back. Give me 1 second here. What the heck? I was talking on mute for a quick second. I'm gonna just go back to the slides. I wasn't saying much of nothing, but what I was saying was you can see the bullet points, right? If you do the math, there will always be 10 times the amount of money. And I wanted to review for a more real world scenario that could actually happen with us. So I'm gonna go back to this video and I'm gonna go back on mute. Hopefully I'll mute myself after this. All right. So let's get to it. All right. 1 second. All right. All right.
It's not how you think. Let's take a look how most people think the banking system works. The saver deposits his money in the bank. The bank lends the money out to a borrower. The borrower pays back the money with interest. The bank gets to keep some interest earned, and so does the saver. It's a win-win situation all the way around. But that's not how it works. Let's take a look how it really works. We'll need to remove the saver. He plays no part in this. A family needs a loan for a home. The bank creates a promissory note the family signs. The bank then creates a bank deposit in the family's name. New money has just been created. Commercial banks like Bank of America, Wells Fargo, Chase, your local bank down the street all have the power to create new money and receive interest from that new money. So how much are these banks making? Let's take a look. Here is a 30-year mortgage on a $600,000 home. In green is how much interest you will pay to the bank over the life of the loan. $531,000 in interest. Look at the payment breakdown. Your first payment is $3,000, and out of that payment the bank gets to keep $2,300 for interest payments on money they created by typing on a keyboard. New money created out of thin air. I know this sounds unbelievable. I didn't believe it either, but it's written in black and white on the Bank of England's website. Let's take a look. On the website for the Bank of England, there's a bulletin, Money Creation in the Modern Economy. It explains in detail how commercial banks create money and lend it out for profit. Let's take a look at some of the highlights. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The reality of how money is created today differs from the description found in some economic textbooks. Rather than the banks receiving deposits when households save and then lending them out, bank lending creates deposits. One common misconception is that banks act simply as intermediaries, lending out the deposits that savers place within them. Viewing banks simply as intermediaries ignores the fact that in reality, in the modern economy, commercial banks are the creators of deposit money. This article explains how, rather than banks lending out deposits that are placed with them, the act of lending creates deposits, the reverse of the sequence typically described in textbooks. And here's the key right here: the act of lending creates deposits, like was shown at the first of the video. Now, if you look over here to the right, you'll see where it says 97% of the amount of currency in circulation is created by these bank loans, created by this money out of thin air. About 3% is cash that you'd hold in your hand that's moving around the economy. The vast majority of money in the economy are created by banks creating these loans. When you drive into a city, take note of the biggest, tallest building. Normally it's a bank. Look at this: First National Bank, Industrial National Bank, U.S. Bank Tower, Dallas Bank of America Plaza. These banks have an amazing gig going. They can create money out of thin air, loan it out, and collect interest. No wonder they're so filthy rich. People are starting to wake up to this corrupt banking system, and Iceland's leading the charge. There's this great write-up, and I'll leave a link in the description below. It says, Monetary Reform, a Better Monetary System for Iceland. And the report was commissioned by the Prime Minister of Iceland. And they're changing their banking system, and it's really amazing. The contents down here, you can see monetary problems in Iceland, the money creation mechanism, a little bit of what we talked about before, the expanding money supply, talk about how they're going to expand the money supply, and fractional reserve issues. And they also have alternatives to fractional reserve banking. And it's good that Iceland is going to make monetary changes. Hopefully the rest of the world can follow. And they may just be doing that. Take a look at this article. American Bankers Association pushing back on CBDC, which is basically digital dollar that the United States is looking at. Be pushing back as hard as they can because they got the gravy train right now and they don't want to lose it. Here's a central bank, or in the United States, the Federal Reserve, it's the main bank. And if they go with the digital dollar, that could put all these commercial banks, Bank of America, Wells Fargo, It could take away their charter to be able to make these loans and collect interest for nothing, which would in a way be good. So here you see the general public down here, instead of them proxying through these commercial banks where they make all this money that we talked about in the video, they will go directly to the central bank or the Federal Reserve. And it may be that they go to the Federal Reserve, like you would go to the Federal Reserve and they would give you a loan for maybe 0.5% of interest or maybe 0% interest. So instead of you taking 30 years to pay off your house through a commercial bank and they get half of that, then you could go to the central bank and get a loan and then pay it off in 15 years because you're not going to be paying all that interest to these commercial banks. So we'll have to see how that goes, but just know that it is in the works and they're looking at that too. So there's a lot of people looking at changing the system. I think a lot more people are becoming aware of what's going on and what has been going on in the past. Here are some famous quotes about banks. I believe that banking institutions are more dangerous to our liberties than standing armies. Thomas Jefferson, third president. If the people only understood the rank injustice of our money and banking system, there would be a revolution by morning. Andrew Jackson. It is well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution by morning. Henry Ford. I'm afraid the ordinary citizen will not like to be told that banks can and do create money. The modern banking system manufactures money out of nothing. The process is perhaps the most astounding piece of sleight of hand that was ever invented.
They don't want a population of citizens capable of critical thinking. They don't want well-informed, well-educated people capable of critical thinking. They're not interested in that. That doesn't help them. That's against their interest. That's right. It's a big club, and you ain't in it. And nobody seems to notice. Nobody seems to care.
I would love to hear your comments. Please leave them below and let me know what you think.
All right, y'all. So that's that, all right? Oh, Lord, what am I doing? Do that again. All right. So that's that. Close this if I can. Goodness. All right. All right, we're going to the slideshow again. All right. So I got one more slide here. What's the problem with it? The problem is also a liquidity crisis. The reason this is in, I start looking into this is because we just ran into a problem where we had 3 banks fail within a week or less. If you've been in the crypto world, there were several other crypto banks as well as exchanges, stable coins, whatever, that also collapsed. They try to make that all about crypto, but it's all interchanged or interconnected to the financial system. There's a problem in the financial system, and that's what I'm trying to expose here. So learning this stuff is kind of critical. Then you understand banking is a scam, right? So let me ask ChatGPT. I'm gonna ask ChatGPT 2 questions: liquidity crisis and bank run. What is it, right? So let me hit up ChatGPT. If y'all don't know what ChatGPT is, it's AI, new AI, right? Anyway, what is a I'm sorry. Summarize. ChatGPT can be kind of chatty or talk too damn much, but yeah, let's tell it to summarize. Summarize. What did I say I was going to ask it? I forgot. What is a liquidity crisis? Actually, I don't think we need to do this. I just thought about it. Yeah, okay. So a liquidity crisis occurs when there is a shortage of cash or liquid assets in a financial system or market, making it difficult or impossible for individuals, companies, or financial institutions to meet their short-term obligations or to access funds to finance their operation. This can lead to a domino effect as defaults and bankruptcies can quickly spread throughout the economy. In severe cases, a liquidity crisis can trigger a financial panic or a system collapse of the financial system. It initially it seems too simple for something like this to be able to happen. This is a complex thing, this one right here. But then when you think about it and you start to look at these slides, for instance, let me go back to this slide. If you look at this slide with only $100 loan being lent out roughly about 9 more times, 10 times, we'll say 10 times. That would almost involve 10 other banks, or it just depends on whether the new person who took the new loan out deposited with the same bank or whatever. But still, if we assume that this is 10 different banks or whatever, because we do bank all over the world, all over the United States and the world, if this happened over and over again, that would mean that these funds are so tightly knit to each other that it weaves the banks together like a rope, right? That would make all these banks tied together through one loan. Imagine hundreds and hundreds of thousands of loans. All these banks are tied together through these reserve process and through this loan process. Let me go back to what I was saying. All right. So what is a bank run? Let's ask Chat GPT, since it just told us what a liquidity crisis is. What is summarize a bank run, right? You get to read. The bank run occurs when a large number of depositors in a bank or financial institution try to withdraw their funds simultaneously because they fear the bank may be insolvent or unable to meet its obligations. The sudden surge in withdrawals can quickly deplete the bank's reserves, leading to a liquidity crisis and potentially forcing the bank to default. Bank runs can be contagious. Yeah, I heard that word quite a lot this weekend. Contagion is what they were saying. Bank runs can be quite contagious, with panic spreading from one bank to another and causing a systematic collapse of the financial system. In some countries, governments have established deposit insurance schemes to protect depositors in case of bank failures and prevent bank runs. Let's this thing right here just made me want to ask one more question. The insurance schemes. Let's see. Let's ask, how many banks can FDIC bail out before they run out of money? All right. The Federal Deposit Insurance Corporation is a U.S. government agency that provides insurance coverage for deposit and member banks and savings institutions. The FDIC is funded through premiums paid by banks and has access to a reserve fund known as the Deposit Insurance Fund to cover insured depositors in the event of a bank failure. The DIF, I don't know what DIF is, has a target reserve ratio of 1.35% of insured deposits. So let me stop right there, because I did watch some other videos trying to figure this thing out. And they mentioned this in some other videos. This is a known number that they can only cover 1.35%. That's 1% of all deposits in America, or wherever however far this banking institution runs across the world. I think FDIC is just for America. So let's keep it local. 1.35%. That ought to scare you. They don't have enough money. Anyway, which means it aims to hold enough funds to cover potential losses from bank failures. As of the end of 2021, the DIF, or the deposit in, what is that called? FDIC? Yeah, whatever. Had a balance of 119 billion. They got banks with larger balances than this. which represents more than 1.3% of insured deposits. Yeah, banks have way more. Oh my goodness, we're in trouble. While the FDIC does not have a specific limit on the number of banks it can bail out, its ability to do so depends on the size and frequency of bank failures and the amount of insured deposits that need to be covered. The FDIC has various tools at its disposal to resolve failing banks, including selling them to healthy banks, creating bridge banks to manage their assets and liabilities, and providing assistance to acquirers. In some cases, the FDIC may also provide additional support from the U.S. Treasury's Temporary Liquidity Guarantee Program. Overall, the FDIC has a strong track record of successfully managing bank failures and protecting depositors. All right, y'all. I'm gonna leave it at that. I could talk on and on about this stuff, but I'm pretty sure this video is getting kind of lengthy. I never really asked, but I might as well start asking. Like and subscribe if you can. If not, whatever. I'm just trying to put this message out to get folks to know, right? Banking is a scam. This entire system is a scam. This is one of the reasons they don't want to move to a blockchain-based currency system, because then they can't make these fake loans and create money out of thin air. When you learn about crypto, you learn that there's limited amounts of tokens that cannot be minted or created out of thin air. It has to all maintain or stay within the confines of that particular blockchain. Now, there are some blockchains that do have unlimited amounts that you can print and so on and so forth. That would be the CBDC as well. They will be able to shrink or grow the supply to fit their needs, raise interest rates. I don't know how they're going to do this CBDC thing completely, but look out, it's coming. All right. That's all I got to say on that. Until next time, I'll see y'all. See you when I see you.